Hey everybody, this is Lincoln from Trading Cage, and today I thought I'd try something new and use this new streaming platform and just live stream some new things that I've been working on that I want to show off. So this is Trading Cage. If you haven't visited it before, it's a replay simulator for futures traders. And what I'm looking at here is the time traveling chart, which allows you to go back to any point in time and see any granularity of chart down to the 1 second chart, back to the inception of all 16 major futures contracts that I have added to this platform. And there may be more of those to come in the future. So ES obviously is the E-mini S&P 500 index futures contract. And the first trading day that I have available is September 10th, 1997, which is either the first or the second trading day that the E-mini ever had. And what I'm looking at here is the 5-minute chart with a 20-period exponential moving average. And I'm just gonna, look through it. I can zoom in. You can see that the overnight session was pretty thinly traded. We're looking at maybe a couple of trades here, a lot of doji candles, perfect dojis, with perhaps only one trade in the 5-minute period. But things start to pick up around, around the open, 8:30 a.m. This is Central Time. And you start to see some recognizable patterns here. So this is useful for people who, have a trading strategy that is working, but they want to go back test it against very old historical data to see if the principles of the strategy are universal. So you can see here we have some consecutive bear bars, consecutive bull bars. We have sort of a trend forming. This is basically a bear channel. And then towards the end of the day, maybe here, depending on how you figure it, we have a bear breakout around 2:15, 2:25 in the last trading hour of the day. And we end on a big red bar right here. This is pretty interesting here. We end at 914.75, but the next trade gaps up 15 points. Okay, and 15 points is a pretty large gap even today, just between two bars. And but keep in mind that the entire index was at 915. So by in terms of percentage, this would be more like a like a 60 or 70 point gap today. But the bear trend continued. You can see we go a couple days, and if you have Trading Cage, you will be able to view this. That's pretty much it on the S&P 500. You can see pretty recognizable stuff here. Now I'm going to go to the NASDAQ and just show you the first trading day of that contract as well. This is the E-mini NASDAQ contract. Looks like the first trading day is in 99, July 1st. So I'll start on the 3rd, so we have a couple days to look back. You can see here July 1st, 1999. Okay, you can sort of figure out, here's where it opened. We opened with a big bear breakout that was reversed, total V-shaped reversal into a bull channel. And you can keep going. You can see we're in, sort of a little bit of an uptrend here for a couple days. I'm going to show Dow Jones as well. 2002 looks like on my sheet here, May 1st. Rather, I'll do the 3rd, and we can scroll back and see the 1st. Here we go. And there you have it. This is the first trading day of the Dow Jones E-mini contract. Well, you may be wondering, what about the contracts before the E-mini? What if you want to test on those? Well, I have them here too. So here is SP, which is the big contract that existed before the E-mini S&P 500 index futures contract. And you can actually see there's significant overlap in the trading. Okay, the SP is 5 times the size of the ES. And obviously the E-mini was created for retail traders, essentially, people who didn't have the size and margin of institutional traders. But the data goes back significantly further for SP. So the data I have goes back to 1982, April 21st. And we're going to switch this to the 15-minute chart because it gets pretty thin on the 5-minute. But here you go. This is April 21st, 1982, the 15-minute chart in the S&P 500. Looks like for a couple of days here, we were in a pretty good bull channel. Okay, so you could draw a line here. You could see, all right, this is a reasonable channel. We have a line on the bottom, we have a line on the top. Maybe your strategy involves lines, maybe it doesn't. And then right around here, we have a convincing breakout with follow through, a bear breakout with follow through of the bull channel. So if you're a price action student, price action trader, you would realize that this suggests we're entering a new phase of the market cycle. That's pretty interesting. I'm going to erase these lines. By the way, volume is unfortunately not available on the intraday chart back this far. I was not able to find any source that has that. But we can look just very briefly at the large NASDAQ contract, ND, which goes back nearly as far, 1996, April 10th. It will just take 1 minute to load this. And we can see the same sort of thing here, right? Like this looks like a potential triangle final flag, right? You have basically 3 pushes down or 2 pushes up. You can identify wedges. You can identify breakout mode when you have these. This is a pretty rare triple inside bar pattern that breaks out to the upside, comes back to retest, the apex of the triangle, and then continues upward in a bull channel. Again, this is the 15-minute chart on the big NASDAQ contract from 1996. I think there's a lot to be learned from these. I think that when you study these old contracts, you can identify things and learn things about how the market works. The market is just a game in mass psychology anyway, and the principles of human psychology and mass psychology are fairly universal. Of course, market mechanics can change over time. These charts look different and much more thinly traded because they didn't have high frequency trading algorithms, which make up the majority of the volume today. And there weren't 0 days to expiration options where you have market makers which are constantly trading in the futures to hedge their options. So the mechanics of the market are fairly different, but you can see some universal principles from the price action here. Now, I have another one that I want to show you. The oldest available contract, and I haven't even loaded this yet, so this may not work, but I think it will, is the British pound contract, which I have back to 1977. So if you look through these contracts, the first 4 are equities: S&P 500, NASDAQ, Dow Jones, and Russell. Then we have crude oil and natural gas, 2 energy contracts. And then I have 4 Forex contracts: Australia, the whatever you call that, AUD, British pound, Australian dollar, British pound, the euro, and the Japanese yen. And then I have 3 treasury contracts: the US bonds, the 5-year and the 10-year, and the 3 old equity contracts. Okay, so British pound was the one I was looking at. I have this back to 1977 of September. This might be too thin to be useful. Yes, you can see this is extremely thin, but we have back to the 1st of September, 1977. Maybe we go to the hourly chart. And this EMA is not very useful. Here's the hourly chart. This is probably too thin to glean anything particularly useful from. But, you know, still kind of fun to look at these things. Okay, I have a couple more that we can look at just briefly. How about crude oil? 1987, January 2nd. We're still on the hourly chart here. I'm a little worried about the liquidity. Maybe this is all right. Let's go to 15, see if it's too thin to understand. I think it's reasonable, and I'm going to go ahead and add back the EMA. Yeah, you can sort of see it's channeling upwards here. We have a push down and a reversal off of the EMA. You have a potential break and reclaim of the EMA here. And here's a break with follow through. And then here, the EMA becomes resistance. Now, you could be fooled by this false breakout right here. You have to come up with some way of identifying that. But after this break, trading range, and then another break to the downside, we're basically channeling down off of the EMA. So if your strategy involves some of these indicators, it could be useful. I have a couple other indicators on here too. I have, you know, average true range. If you're looking at the average true range of these hourly bars, looks like it's pretty darn small. 0.07 is the average true range for the bar I'm looking at right now. We could add RSI. If you trade RSI divergences, you know, maybe this would mean something to you. That is pretty much it. I have several other contracts here I could go through, but this video is already pretty long, and I think I've made my point. Yeah, this is basically what I wanted to show. I think this is the main reason why you should use Trading Cage, if or you might want to use Trading Cage instead of other simulators that are out there. This is the only place where you'll be able to take these futures contracts and go back to the very beginning, the very first trading day of every single one of these contracts. And you can put your indicators on there. You can put the 5-minute chart, the 15-minute chart, the hourly, the daily. You can do the daily with the regular hours, daily with the extended hours. I've done extended hours for this video just because I thought it was more interesting that way. But, you know, the regular hours depends on each contract. For the equity contracts, that's 8:30 to 3 Central Time. And but, you know, like crude oil has different regular trading hours. Forex has the various sessions that I'll be adding shortly. But that is pretty much it. Hope you enjoy. Trading Cage is actually not available at the moment because the private beta just ended. And I'll be relaunching as a public product in just a couple weeks here. So if this interests you, keep an eye out for it. Follow me on Twitter, follow me on YouTube, wherever you like, and I'll be posting about it. Thanks for watching.